There is a specific kind of silence that accompanies a paradigm shift. It isn't the loud, boisterous noise of a market floor or the frantic shouting of a trading pit. It is the quiet hum of a data center, the imperceptible flicker of an optical fiber, and the soft tap of a finger on a screen. For those of us who have spent decades navigating the traditional world of finance, the world of physical bank branches, paper statements, and personal brokers, the rise of financial technology or FinTech can feel like a departure from reality. But I would argue it is quite the opposite. It is an intensification of reality. We are witnessing the plumbing of our civilization being replaced while the water is still running. If you are over 40, you have likely built your life on the bedrock of established institutions. You understand the value of a handshake and the weight of a signed document. However, the architecture of trust is changing. To ignore FinTech today is not merely a refusal to adopt a new gadget. It is a refusal to understand how the value you have spent a lifetime accumulating is being measured, stored, and moved. My name is the Horizon. Today, we aren't looking for the next big thing or a quick win. We are here to conduct a sober, intellectual audit of the intersection between finance and technology. We are going to look beneath the surface of the hype and examine the machinery that will define the next 40 years of our economic lives. Welcome to a deep dive into the foundations of FinTech. To understand where we are going, we must acknowledge the end of the software-only era. Between 2010 and 2020, capital flooded into light assets, SaaS companies, social media platforms, and digital currencies that required very little in terms of physical overhead. This led to a sort of intellectual laziness in the markets. We forgot that every bit of data processed is a physical event occurring in a physical location. Starting around 2021, the world hit a wall. Supply chain disruptions were the first tremor, but the second was more profound. The realization that our digital ambitions have outpaced our electrical reality. The surge in demand for high-performance computing, driven first by the maturation of decentralized networks and then by the explosion of generative AI, has turned energy from a background utility into the primary constraint of capital. We have shifted from a world of speculative code to a world of physical constraints. If the last 20 years were about who could write the best algorithm, the next 20 will be about who owns the electrons required to run them. We are moving past digital gold toward what I call thermodynamic sovereignty. What exactly is the core mechanism of this disruption? If we strip away the clever branding and the sleek mobile interfaces, FinTech is essentially a war on friction. In the traditional model, every time money moves, it passes through a series of toll booths, compliance checks, correspondent banks, clearing houses, and manual reconciliations. Each of these steps adds time, cost, and human error. FinTech utilizes a concept known as disintermediation. It is the removal of the middleman. By using software to automate trust, these platforms can operate at a fraction of the cost of a traditional bank. Consider the chart before you. For decades, the cost of moving money across borders was an accepted tax on global trade, largely because the infrastructure was a monopoly held by large institutions. FinTech hasn't just improved this, it has fundamentally broken the monopoly. But the disruption goes deeper than just fees. It is about the democratization of sophisticated financial tools. In the past, high-level wealth management, complex derivatives, and venture capital were the exclusive domain of the ultra-high net worth individual. Today, an algorithm can provide a diversified, tax-loss harvested portfolio to anyone with a smartphone. This isn't just a change in technology. It's a shift in the power dynamic between the institution and the individual. We are moving from a world where you go to a bank, to a world where banking is an invisible utility integrated into your daily life. To truly grasp the future, we must look at the three pillars that support the modern FinTech architecture: blockchain, artificial intelligence, and data analytics. Let us begin with blockchain, perhaps the most misunderstood of the three. Forget the volatility of cryptocurrencies for a moment. At its core, a blockchain is a distributed ledger of truth. In our current system, we rely on a central authority, a bank or a government, to tell us who owns what. Blockchain allows for a system where the record of ownership is shared across a network, making it nearly impossible to alter or forge. It is the transition from trust in institutions to trust in math. Next, we have artificial intelligence. In finance, AI isn't about science fiction. It's about pattern recognition at a scale no human could ever achieve. It's about analyzing millions of data points in real time to detect a single fraudulent transaction or to predict a market shift before it happens. It replaces the gut feeling of a loan officer with the cold, objective logic of a machine learning model. And finally, there is data, the fuel for the entire machine. We are generating more financial data in a single day than our grandparents did in their entire lives. Every transaction, every GPS ping, every social interaction is a signal. FinTech companies use this data to build alternative credit scores, allowing them to lend to people who might be invisible to a traditional bank. When you combine these three, a decentralized ledger, an intelligent processor, and an infinite supply of data, you don't just get a better bank. You get an entirely new way of organizing human economic activity. It is a profound shift in how we define value itself. We must ask ourselves, why is this happening now, and why is the pace accelerating? Look at the sheer volume of capital flowing into this sector. This isn't speculative, funny money. This is the smart money of the world betting that the current financial infrastructure is obsolete. For the man over 40, this carries a specific weight. We are at an age where capital preservation is as important as growth. The institutions we trusted for decades are themselves scrambling to integrate these technologies to stay relevant. They realize that the moat they once had, their physical branches and their regulatory licenses, is being bridged by code. This surge you see in the data represents a fundamental rewiring of the global economy. It is the sound of the old world being upgraded. As we move forward, the question isn't whether you will use FinTech, you likely already do, perhaps without knowing it. The question is whether you understand the risks and the opportunities inherent in a system that moves at the speed of light. In the next part of our exploration, we will move beyond the mechanics and look at the shadows, the risks, the regulations, and the reality of navigating this new frontier. But for now, take a moment to consider the scale of what we've discussed. The ledger of human history is being rewritten in digital ink, and for the first time, the gatekeepers are no longer in charge. We have spent the first half of our journey discussing the brilliance of the architecture, the way technology has streamlined the movement of capital. But as men who have lived through market cycles, we know that every innovation carries its own shadow. In the traditional world, friction was a nuisance, but it was also a safety valve. If you wanted to move $1 million, you had to speak to a person. There were checks, balances, and most importantly, time. In the FinTech era, that friction has evaporated, and with it, the margin for error has narrowed. When we talk about the hidden risks of this new landscape, we must start with cybersecurity. It is no longer about a lone hacker in a basement. It is about sophisticated, state-level actors and AI-driven social engineering. For the individual investor over 40, the risk isn't just a stolen password. It's the systemic vulnerability of just-in-time financial data. If the ledger is digital and instantaneous, the speed at which a contagion can spread is unprecedented. We saw glimpses of this in the flash crashes of the last decade, but in a fully integrated FinTech ecosystem, the feedback loops are even tighter. We must ask ourselves, in our quest for efficiency, have we built a system that is too efficient for its own good? One where a single algorithmic error or a breach in a third-party API can trigger a cascade before a human being even enters the room. Beyond the technical vulnerabilities lies the regulatory challenge. Legislation is, by its nature, reactive. It is the lagging indicator of the financial world. We are currently living in a period of profound asymmetry. On one side, we have big tech and agile startups moving at the speed of code. On the other, we have regulatory bodies, the SEC, the FCA, the ECB, operating on a 20th century timeline of committee meetings and public comment periods. This gap creates a gray market risk. For those of us managing portfolios or businesses, this uncertainty is a cost. When a new platform offers you a 10% yield through a decentralized lending protocol, you aren't just looking at market risk. You are looking at jurisdictional risk. If the protocol fails, who is the lender of last resort? Who do you call? The sobering truth is that in many of these new frontiers, the answer is no one. This is why intellectual honesty is paramount. We cannot pretend that digital means safe. As we move forward, the most successful FinTech adopters won't be those who chase the highest yield, but those who understand the regulatory moats surrounding their assets. We are seeing a shift where compliance is no longer a back-office burden, but a primary competitive advantage for any platform that wants to survive the next 20 years. If we look toward the horizon, the most significant trend in FinTech isn't a new app or a specific coin. It is the concept of embedded finance. This is the idea that financial services will eventually become invisible. Think about how you pay for a rideshare service today. You don't pay in the traditional sense. The transaction happens in the background, woven into the utility of the service. In the coming decade, this will expand into every facet of our lives. Your car will handle its own insurance and tolls via its own digital wallet. Small businesses will receive credit offers at the exact moment their inventory management software detects a shortage, with the loan terms calculated in milliseconds based on real-time cash flow, not a credit score from 3 months ago. For the mature investor, this presents a shift in how we value companies. We are moving away from a world where finance is a vertical industry and into a world where finance is a horizontal layer across all industries. The alpha of the future won't be found in picking the best bank, but in identifying the platforms that successfully integrate these invisible financial layers into their core products. We are witnessing the democratization of the balance sheet. While we often focus on our own portfolios, the most profound future scenario is the global rebalancing of financial power. In emerging markets, FinTech isn't just an upgrade to existing systems. It is the system. In sub-Saharan Africa or Southeast Asia, millions are skipping the checking account and credit card phase of history and moving straight to mobile-first, blockchain-verified identity and commerce. This isn't just a humanitarian success story, it's an economic one. It brings billions of people into the global marketplace as producers and consumers. For the long-term thinker, this is where the real sustainability lies. As these populations gain access to credit, insurance, and global markets via their smartphones, the center of gravity for global growth will continue to shift. This is the evergreen opportunity. While the West iterates on user interfaces, the rest of the world is building a new financial infrastructure from the ground up. Understanding this shift is the difference between being a passive observer and an informed participant in the global economy. To ground these concepts, let's look at a real-world implementation that has already changed the world. Stripe. While most people see it as just a way to pay for things online, Stripe represents the quintessential FinTech success. They didn't build a bank. They built the plumbing that allows any business to act like a global financial institution. By reducing thousands of lines of code and months of regulatory paperwork into a single integration, they enabled a decade of economic growth. Consider also the evolution of Vanguard. Here is an institution that many of us have trusted for decades. Their move into personal advisor services, which uses sophisticated algorithms to automate rebalancing while keeping human advisors for the complex emotional decisions, is the perfect example of the hybrid model. It isn't human versus machine. It is the machine handling the math so the human can handle the strategy. These aren't just startups anymore. These are the new foundations of our financial lives. They demonstrate that the most successful implementations of FinTech are those that solve for trust and simplicity, not just those with the flashiest technology. We have covered a lot of ground, from the history of the ledger to the invisible finance of the future. But what is the practical takeaway for the man over 40? For the steward of a family's future or a business's legacy? First, do not be intimidated by the jargon. Whether it is called DeFi, AI, or blockchain, the fundamental principles of finance remain unchanged. Risk, reward, liquidity, and trust. Technology changes the how, but it doesn't change the why. Second, prioritize resilience over optimization. In an age of high-speed volatility, having a portion of your wealth in slow assets is not a failure. It is a strategy. Use FinTech to lower your costs and gain access to new markets, but never let the ease of a one-click trade bypass your inherent wisdom. And finally, stay curious. The greatest risk in this new era is not losing money on a bad trade, but becoming obsolete through a lack of understanding. You don't need to be a coder, but you do need to be a critic. Ask the hard questions about where your data goes and who holds the keys to your assets. The ledger of human history is indeed being rewritten in digital ink. The gatekeepers are changing, but the need for steady, sober leadership has never been greater. The horizon is wide, and for those who choose to understand it, the future isn't a threat, it's a destination. I'm the horizon. Thank you for your time.